What are the debt-to-income ratio requirements for USDA loans? Have you ever wondered how lenders decide if you can afford a loan? One key factor is the debt-to-income ratio. This ratio is especially important when considering United States Department of Agriculture loans. So, what exactly are the requirements for this ratio when applying for a USDA loan? The debt-to-income ratio is calculated by dividing your total monthly debt payments by your gross monthly income. This gives lenders a clear picture of how much of your income goes toward paying off debts. There are two main components to consider: the front-end ratio and the back-end ratio. The front-end ratio focuses on housing expenses. This includes principal, interest, taxes, and insurance, often referred to as PITI. For USDA loans, the front-end ratio is typically expected to be 29% or less. This means that no more than 29% of your gross monthly income should go toward housing costs. On the other hand, the back-end ratio takes into account all monthly debt obligations. This includes housing expenses, car loans, student loans, credit card payments, and any other recurring debts. The standard back-end debt-to-income limit for USDA loans is generally 41%. This means that your total monthly debt payments should not exceed 41% of your gross monthly income. Now, what if your debt-to-income ratio is higher than these limits? There is some flexibility here. If you have strong compensating factors, such as a high credit score or significant cash reserves, you may still qualify for a USDA loan. This is particularly helpful for real estate investors who might have a higher debt load due to other investments. It's also important to note that while the USDA sets these general guidelines, individual lenders may have their own requirements. This means that different lenders might assess your debt-to-income ratio differently, allowing for more flexibility in some cases. Understanding these debt-to-income requirements can help you strategize your real estate investments. If you plan to finance multiple properties, managing your debt-to-income ratio becomes even more important. This will ensure that you can secure financing for future projects while maintaining financial stability. In summary, knowing the debt-to-income ratio requirements for USDA loans is essential for anyone looking to invest in real estate. By keeping your front-end ratio at 29% or less and your back-end ratio at 41% or less, you can position yourself for success in your real estate endeavors.